Good evening. Good evening. My name is Claribel Martinez. I am a business counselor at the Entrepreneurial Assistance Center. Tonight's webinar is about we're just going to cover some basic tax deductions for small businesses. So you have an idea of some things that you can write or can't write off in your taxes when you file every year. We're also gonna talk about what you can deduct and how much you can deduct. So let's just get started. What can I deduct? So in order for your expense to be deductible, it has to meet two requisites. It must be a business expense must be both ordinary and necessary. An ordinary expense is an expense that is common and accepted in your industry. A necessary expense is one that is helpful and appropriate for your trade or business. An expense does not have to be indispensable for it to be necessary. It just needs to be necessary to you. If you feel you need it for your business, and it's, I guess we can use our common sense, like, was this necessary or not necessary for your business? Like, I mean, what can I think of an example? Like, if you're selling perfume and you're out buying, let's say, diamonds or something like that, something very expensive, like you have a restaurant, like what do you need diamonds for a restaurant? Like, it just has to make sense, basically. Yeah. So we'll talk about the most of the basic common things that you can deduct for your businesses. The main one is, of course, cost of goods sold, which is basically the cost of making your product or that you pay for your product if you're not buying it. If your business manufactures products or purchases them for resale, you generally value your inventory at the beginning and end of each tax year to determine your cost of goods sold. Some of your business's expenses may be included in figuring cost of goods sold. Cost of goods sold is deducted from your gross receipts to figure gross profit for the year. So the cost of goods sold includes your raw materials, and it includes the freight to get the material shipped, your storage, and any direct labor that is associated with making this product or getting it to your store, and any overhead that's directly related to the product. So that is what it cost of goods sold. That's all that is deductible on your taxes. Your employees' pay, which includes the amounts you pay your employees. All right. You can generally deduct the amount you pay your employees for the services they perform. This could be cash, property, services. It may include wages, salaries, bonuses, commissions, or any non-cash compensations such as vacation allowances and fringe benefits. All that is deductible on your taxes. Any benefits that you offer to your employees, you can deduct from your taxes. Rent expense. So rent is any amount you pay for the use of property that you do not own. In general, you can deduct rent as an expense only if the rent is for property you use in your trade or business. So any amount you pay for use of the property you do not own, it can be expense only if the rent is for property you use in trade or business. If you rent your home and you do your business out of your home, or you have to, the portion of your home that you're using towards your business, you can deduct that portion of the rent. So let's say but you must have a designated part of your home that's used only for that business. Decide what percentage in square feet it is, and you can deduct that amount. Like, let's say if you're using half of your home for your business, then that half you can deduct it in your business taxes. Generally, rent paid for use for property in your trade or business is deductible in the year it occurs. So the year that it happens. So whatever rent you pay for that year, you expense that year. If you have, like, let's say a lease where you prepaid rent for, like, let's say you rented a bit like a building for your business, and you prepay, let's say 5 years of the lease, you would expense the first year, and you'll capitalize the other 4 years. So let's go a little bit into more detail. So generally, rent paid for use of property in your trade or business is deductible in the year paid or incurred. If you're an accrual method taxpayer and pay rent in advance, you can deduct only the amount of the rent that applies to your use of rented property during the tax year. You can deduct the rest of the rent payment only over the period to which it applies. So as the years go by, you could take it out of your assets account and expense it year by year. If you're a cash method payer, if you're a cash method taxpayer, you may deduct the entire amount of your rent paid in advance in the year of payment if the payment applies to the right to use the property that does not extend beyond the earlier of 12 months after the first day you have the right to use the property, or extend or the end of the tax year following the next year in which you pay the advance rent. If your payment applies to the right to use the property beyond this period, then you must capitalize the rent payment and deduct it over a period to which it applies. So you basically can only go 1 year ahead if you're a cash method taxpayer. Here are some examples, right? Example 1, you're an accrual method calendar taxpayer. This means that your business has a calendar year, tax year. So from January to December, you have a lease, a building with a rent of $1,000 beginning July 1st, 2022, and June 23rd, you pay an advance of $12,000 for the last 6 months of 2022 and the first 6 months of 2023. You can deduct only $6,000 for 2022 for the right to use the property in 2022, and then you deduct the other $6,000 in 2023. So here's another example. So same thing. Example 1, except you're a cash method calendar year person. So you can deduct the $12,000 payment in 2022 because the payment applies to the right to use your property does not extend beyond 12 months after the date you received this right. If you deduct the $12,000 in 2022, you should not deduct any part of this payment in 2023. So you have the option if you're a cash payment. And the difference between the two is like if you're accrual, so you're accruing the expenses and paying them as as you incur the expense. As of cash basis, you're deducting from your taxes as the cash comes out. As even if like you haven't actually lived there for the 12 months. So there's a difference between cash and accrual method. You are either a cash or accrual method taxpayer. It's another example. Last January, you leased the property for 3 years for $3,000 per year. You can pay the full $18,000 of 3 years times $6,000 during the first year of the lease. Because this amount is a prepaid expense that must be capitalized, you can deduct only $6,000 per year, the amount allocable to use your property in this year, because it's just from January. So only for that 1 year. If you're accrual, if you're tax, you can only go 1 year ahead. So also only for that 1 year, and the rest must be capitalized. Any questions about that? Yeah. Okay. If your lease property, also you have to pay taxes to the landlord. That can also be deducted from your taxes. So if you lease property, you can deduct any additional rents, taxes you have to pay to the lessor, and that's all deductible. And business interest on money you borrowed. So if you borrow money from a bank, you take a loan from anybody, then charge you interest, you can write that off as an expense. You must generally limit business interest expense you pay or accrue during the tax years unless it's an exception. If you have an exception, and these are specific to each business. So It does not matter what type of property secures the loan. You can deduct interest on a debt only if you meet all the following requirements. You are legally liable for that debt. Both you and the lender intend that the debt are repaid. You and the lender have a true debtor credit relationship. So you have to make sure you maintain records of this. You can't just say, oh, I think this is just to make sure that people are not just saying, oh, I loaned so-and-so, I borrow from so-and-so and I'm paying them interest. And, just make sure that it's, I guess, so it's legit. So as long as you keep your good records, you should be fine with this. And you can borrow from anybody and pay interest to anybody as long as you keep a good record of it and that you prove that you're paying them. Any questions on this? Okay. I'm going a little fast, let me know. Sometimes I tend to go a little fast. So any taxes that you paid to government agencies is deductible on your you can expense, and you can deduct various federal, state, local, and foreign tax directly attributable to your trade or business as a business expense. Generally, you can only deduct taxes in the year you pay them. So real estate taxes are deductible. Real estate taxes are any state or local taxes, including taxes imposed by U.S. possession on real estate levied for the general public welfare. Federal income taxes are not tax deductible, so you cannot deduct them. But any payments you made towards a state and income tax, a corporation or partnership can deduct state and local income tax imposed on the corporation as a business expense. Employment taxes. So if you have employees, you must withhold taxes from them, and you pay that along with your share of the taxes, which your share will be Social Security and Medicare. And if you let them go, you have to pay unemployment taxes also. As you know, before you let them go, you pay the unemployment taxes on their weekly paychecks. That's your portion. The Social Security is half you, half them. Medicare is half you, half them. Unemployment is all you. But you pay it, you hold it, and then at the end of you have to pay it, and then you can deduct it. Also, other taxes. The following other taxes you can deduct. If you incur them in the ordinary course of your trade or business. Excise tax, franchise tax, fuel tax, occupational taxes, personal property tax, and sales tax. Excise tax, generally you can deduct as a business expense. Taxes that are ordinary and necessary expense of carrying on your trade of business. Franchise tax, you can deduct corporate franchise tax as a business expense. Fuel taxes, generally taxes on gasoline, diesel fuel, motor fuels that you use in your business are included as part of the cost of the fuel. You do not deduct these taxes as a separate item. So normally if you buy fuel, you deduct the fuel plus the tax. It wouldn't be like separate items. Occupational taxes, you can deduct as a business expense and occupational tax charge as a flat rate by a locality for the privilege of working or conducting business in the locality. Personal property tax, you can deduct any tax imposed by a local or state government on personal property tax used in your trade or business. Sales tax, any sales tax you pay on a service for your business or on the purchase of any property in your business. So if you buy materials or anything and you pay sales tax on that, when you go to deduct the expense, you deduct the whole thing, including the sales tax. If the service or the cost or use of the property is deductible business expense, you can deduct the tax as part of the service or cost. If the property is merchandise bought for resale, the sales tax part is part of the cost of the merchandise. If the property is depreciable at the taxable basis for depreciation. Any questions? And this one. Right, so if there are no questions, we'll go on to slide 12. And only insurance for your business is deductible. You can generally deduct premiums you pay for the following kinds of insurance related to your trade or business. So insurance that covers fire, storm, theft, accident, or similar losses. Credit insurance that covers losses from business, bad debts, group hospitalization and medical insurance for employees, liability insurance, malpractice insurance, workers' compensation insurance, overhead insurance that pays for business overhead expenses that you have during long periods of disability caused by your injury or sickness, car and other vehicle insurance that covers vehicles used in your business for liability damage and other losses. If you operate a vehicle partly for personal use and partly for business, deduct only the part of the insurance premium that applies to the business use of the vehicle. If you use the standard mileage rate to figure your car expense, you can't deduct any car insurance premiums. So you have to either use the car insurance or use your mileage rate. Life insurance covering your officers and employees if you aren't directly or indirectly a beneficiary under the contract, then you can deduct that. Business interruptions insurance that pays for loss of profits. So if you have a business interruption insurance pays for loss of profits if your business is shut down due to a fire or other costs, that is deductible. Self-employed healthcare insurance, you may be able to deduct the amount you paid for your medical and dental insurance and qualified long-term care insurance for yourself, your spouse, and your dependents. The health insurance can cover your child who was under age 27 or adopt a child under 27. Any questions? Okay, so basically any type of insurance that you open for your business is insurance expense and can be deducted from your taxes, as long as it's directly related to your business and is reasonable. Business startup and organizational costs. So this is the cost to start your business, to get your business started. Generally, business startup organization costs are generally capital expenditures. However, you can elect to deduct up to $5,000 of business startup and $5,000 of organizational costs paid or incurred after October 2004. The $5,000 deduction is reduced by the amount your total startup and organization cost exceeds $50,000. Any remaining costs must be amortized. For information about amortization, is basically the same as when you capitalize something and you expense it over time. It's the same thing with like when you depreciate something, it's the same thing, just called amortization. Startup costs include any amounts paid or incurred in connection with creating an active trade or business or investigating the creation or acquisition of an active trade or business. Organizational costs include the cost of creating a corporation or partnership. Any retired assets removal. So if you, let's say you purchase an asset, and I don't know if you guys were here for the last presentation about the how to read your financial statements. So when you purchase an asset, it will go on your balance sheet as an asset. Like let's say if you buy a machine that's cost like say $50,000, that machine will go into your balance sheet as an asset, and you would expense only, like you wouldn't expense the whole thing. You would expense it over time as depreciation, little by little, until it's completely depreciated. And then once it's completely depreciated, if you want to get rid of it and get a new one, or if you retire it, any like, let's say if you want to get rid of it or stroke it, any cost to retire this asset is deductible on your taxes. So if you remove an asset in connection with installation, like replacement, and the replacement asset, you could deduct the cost of removing the retired asset and bringing in the new one. If you have a replacement part of a depreciable asset, capitalized removal costs. If it's an improvement, deduct the cost. So if you're just fixing it, it's a repair. Like, it's a repair expense, you expense it as repair. But if you're making capital improvements on the asset, then you would have to capitalize that cost. If you're buying a new asset, then all the cost of getting rid of the old one and bringing the new one, you capitalize it along with the new asset. If you're just throwing the old one out, then you would just expense the cost of throwing it out and getting rid of it. Does that make sense? Or does anybody have questions? No, I don't see any questions. Okay, so let's keep going. Business bad debts. If you have bad debts, bad debts means that you can't collect. If you're selling on credit, if you're giving customers terms and you definitely know that you will not get the money, you can expense that as a bad debt. So a bad debt is either a business bad debt or non-business bad debt. A business bad debt is one that comes from up your everyday operating expenses. You're selling your merchandise, somebody didn't pay you for it. All other bad debts are non-business bad debts are deductible only as a short-term capital losses. So it's like, let's say, one of those machines that from the previous slide, you decide to sell it to somebody for $2,000. It's not a part of your everyday business, but you just sell it to somebody on terms and they didn't pay you for it. So that's a non-business bad debt right there. So you could expense that. You could expense that on your taxes to lower your taxes because you did lose money. Work-related car use. If you use your car strictly for work-related purposes, you can write off all costs associated with operating and maintaining it. If your car is mixed between business and personal reasons, you can only deduct the costs that are related to the business usage of the vehicle. So you have to kind of figure out what percentage of the time are you using this car for business, and then I guess you can deduct that percentage from your taxes of the cost. You can claim your mileage used for your business driving either by deducting the actual mileage traveled for business or by using the standard mile deduction, which is 56 cents per mile driven. So you can either like keep all your receipts or just like see how much you drove and deduct the standard. I would normally people do both and use the highest one. Like if you keep receipts for your gas and everything you spend on your car, and it's less than if you were to take the standard 50 cents per mile, then you would take that. But if your actual expense for the car is higher than this, then you would take whatever is higher. Does that make sense? Any questions? Okay. So standard mileage rate, once again, for year 22, the standard mileage rate of the cost of operating your car, van, pickup, pedal for business is 58.7 cents per mile from January 1, 2022 to June 30th. This is for the people who filed already taxes for last year. And then it changed in July. So from July to December, 62.5 cents per mile. Meals, you can generally deduct only 50% of any otherwise deductible business-related meal expenses, you reimburse your employees. The deduction limit applies if you reimburse them for 100% of the expenses. Application of this is so the 50% limit applies to reimbursements you make to your employees for expenses they incur for meals while traveling away from home on business and meals for business customers at your place of business. Restaurant or another location. It applies to expenses incurred at business convention. Hi.
Hi, it's Kenya from Suffolk. How are you?
I am good, Kenya.
Suffolk Community College, you were registered for the webinar. Did you receive the Zoom information all right, or you just couldn't make it?
Oh, she's talking to somebody else.
Right.
It applies to expense incurred at a business convention, a reception, business meeting, or business luncheon at a club. The deduction limit may also apply to meals you furnish on your premises to your employees. So anything that any business meeting, any lunch that you buy your employees, or a partner or a customer, you can deduct 50%. If you reimburse, like if your employees have to travel for work, or if you have to travel for work, you can reimburse travel and non-entertainment related meals. For some reason, they did away with the entertainment related meals, but you can still like deduct other non-entertainment related meals. So allowances you pay for your employees under a reimbursement allowance arrangement for travel and non-entertainment related meals expensive. So it's basically they're there to work, not to entertain. So that also includes also like a hotel, plane, travel, and that's just meals. Also travel and if they take train or plane, or if they drive, they can use the mileage or the gas. You can reimburse them, and then you can write that off on your taxes. Or if you yourself have to travel for your business, you can write that off too. So just same as before, must be ordinary and necessary expense, including while carrying on your trade or business. So basically, it has to be necessary and ordinary, which means it has to make sense, right? Like if you're they're gonna look at the type of travel you do. If you're traveling with your whole family and you go to a very luxurious vacation, they're gonna question it, right? So you just kind of like use your common sense. Does this make sense? Will they accept it? And then that's basically what ordinary and necessary means. And they can prove that you needed to go there for your job, for your business. Home office expenses can be deductible. You could deduct, like if you have a home office at your home where you conduct your business out of, you can deduct $5 per square foot of your home that's used for business purposes up to 300 square feet. Your work area has to be used exclusively for business, so it have to designate an area of your home that's only used for that purpose. You need to use the home office regularly as your principal place for conducting business. So you have to actually use it for your business. You can just put it aside and never use it. So you can use that. You can also deduct, you can use this formula right here, or you can use a percentage of your total like expenses for your home. Like, oh, Jennifer, hi. Did you raise your hand?
Yes, sorry. Let's say you have a baking business and you can bake from home. You have the licenses to bake from home. How
Yes.
would that work, deducting it that way? Because you use your kitchen regularly for regular cooking as well.
Right. So then like you would have to kind of calculate how much of your kitchen you're using for business, right? So if you say, in this case, you would say, you kind of give yourself an estimate, like, okay, I use my kitchen half the time for my business. So you would take like your electric, that portion of the rent of, that you use in your home. Like, let's say if you calculate that I'm using my home, 20% of my home for business, right? So you would deduct 20% of all your rent, your rent, your electric, all those things, gas, any bills that you have, you take 20%. So you just kind of do a calculation like, I calculate that 20% of my time of my home is being used for my business, and you just take 20% of all your expenses from your home. Does that make sense?
Yes, thank you.
Because they say they're not really coming into your home and be like, let me prove to me that you're only using this for business. Like, you could have used common sense. If it's not like a crazy amount that they're gonna question it, they're not gonna, really question it like that. If it makes sense, like they said, with the natural, there has to make sense to your business. But yeah, if you use your kitchen for both, it's like the same with the car, right? You use your car for both business and home, then you have to figure out what percentage of it you're using for your business, and you deduct that percentage. But like, you can use the $35 per square feet because you use it for both. So you would just deduct that percentage of all your home expenses. Like, if you decide that 20% is what you're using for business, then you deduct 20% of all your house expenses to your business. Makes sense?
Yes, thank
Okay. You're welcome. This is. Okay. Office supplies, obviously, you can write off all office supplies, including printers, papers, pens, computers, work-related software. You can use them for business. You must use them for business purposes within the year in which they were purchased. You can also deduct work-related postage, shipping costs. All that is deductible. Anything office-related, envelopes, anything that you need for your business. I mean, they say you have to use it within that year, but I have no way of knowing that this pen was used this year or not. So, advertising expense, you can generally deduct reasonable advertising expense that are directly related to your business. So any ads that you take in the paper, radio, if you advertise on social media, you have to pay, that's deductible. Any credit card convenience fees, if you have a business credit card and they, charge a fee. If you take credit card payments from customers and the credit card charges you a fee, that you can deduct that. So credit card companies charge fee to business to accept their cards. This fee, when paid or incurred by the business, can be deducted as a business expense. Charitable contributions, if you donate to charity, you can deduct it. Phone and internet expenses you can deduct. Obviously, they're gonna say it has to be used for business. If you have a home office, you would say how much, have to decide how much percentage of this phone is being used for business and deduct that percentage of your bill. Same with the internet, anything else. Depreciation, like we spoke before, when you buy a big ticket item and you have to capitalize it, you depreciate it every year. Every year you deduct depreciation on this asset. So for long-term business, when you deduct depreciation, you're writing off the cost of a big ticket item like a car, machinery over the useful life of this item, rather than deducting it all in one go for a single tax year. Businesses usually deduct depreciation for long-term business investments that are more costly, so they're reimbursed for the expense over the entire useful lifetime of the item. Childcare expenses, that you incur to run your business, you could write it off. It also applies if you have adults that you are taking care of. Educational expenses, ordinary and necessary expenses paid for the cost of education and training of your employees are deductible. So if you help your employees, some companies give money to the employees and they want to go back to school, that's deductible. Franchise, trademark, trade name, if you buy a franchise, a trademark or trade name, you can deduct the amount you pay or incur as a business expense only if your payments are part of the series of payments. So this is contingent on productivity. If it's payable at least annually for the entire term of the transfer agreement and substantially equal in amount or payable under a fixed formula. So all this will be in your contract if you buy a franchise, and then you will have your accountant and your attorney look at these things, and they will advise you how much of that, is deductible, which most of it will be. Any legal and professional fees charged by accountants and attorneys are ordinary and necessary expenses directly related to operating your business. These are tax deductibles. However, any legal fees that you pay to acquire the business asset usually are not deductible. Any license and regulation fees for your trade or business paid annually to any state or local government are deductible. So like, let's say your liquor licenses, if you have a restaurant, any licenses that is required, food licenses, those are the any fees that's deductible. Repairs, the cost of improving property used in your trade or business, either deductible or capital expense. So if it's like a small repair, you could just expense it right there. If it's like a big improvement that will improve the property itself, then that is considered capital expense. So you would add it to the cost of the asset. So because it improves it, so now it costs more. So it's worth more, is what I mean to say. Your asset is worth more, but at the same time, you can start depreciating that extra expense over time. Impairment related, if you're disabled, you can deduct expenses necessary for you to be able to work. Impairment related expenses as a business expense rather than as a medical expense. So if you're disabled, you have either of the following: physical or mental disability, physical or mental disability that limits your life and you need to buy certain things so you can work and you can run your business. Anything that you need to install in your business so you can work and you can run it properly, then you can expense that. The expense qualifies as a business expense if all of the following apply. Your work clearly requires the expense for you to satisfactorily perform that work. The goods or service purchases are clearly not needed or used other than incidentally in your personal activities. The treatment isn't specifically provided for under the other tax law provision. So if there's no other tax law provision, then you could just use this the impairment related expenses. Capital expenses are costs that are part of your investment in your business. Capital expenses are considered assets in your business. General type of capital expenses, business startup, business assets, any improvements that you do to your business. These capital expenses are normally depreciated over time. So if you're going into business, the cost of getting your business started, which is your startup cost, is deductible. When you go into business, so if you're thinking about going into business and you already started spending money to go into business, save your receipts, because once you open your business, all that is deductible as startup costs. So when you go into business, you treat all your costs that you had to get your business capital expenses. So you save all your business, even if your business is not open, anything that you're spending right now to advertise your business or get your business running, save all your receipts. And once your business open, you deduct it all from your as capital, as your startup costs. If you attempt to start a business and you're unsuccessful, let's say in the past, it falls under two categories. The first one is the cost you had before making a decision to acquire or begin a business. These costs are personal and non-deductible. They include any costs incurred during a general search for or preliminary investigation on a business or investment property possibility. And then, so that's not deductible, but any cost you had in your attempt to acquire or begin a specific business, these costs are capital expenses and you can deduct it as a capital loss. Any questions? I think that was my last slide. So if you guys have any specific questions about certain things that you want to know if it's deductible or not, we can use this time to answer them. If I missed anything that you guys feel should have been included, let me know and I'll add it for the next time.
Feel free to unmute to raise your questions to Clarabelle. You have that capability at this time.
Yes, if you go to the IRS's publication, I'll show you a lot more expenses, but here this website FreshBooks that I use also has some pointers. Yeah, any questions?
Yeah, hello.
Yeah, hi,
Yes, I want, how long can you hold the receipts for?
5 years.
5 years?
Mhm.
Okay.
Mhm.
Yeah, I thought it was gonna be a year, 5 years, okay,
Yeah. Mhm.
all right, good. Thank you, by the way.
Oh, you're welcome. My pleasure. If you have any other questions or anything that you can't think of at the moment, here's my email. You can email Kenya, you can email Jennifer, or you can just email me directly there.
I will, thank you very much.
Okay, you're very welcome.
Okay, then if there's no other questions, I believe we could wrap it up this evening. I thank you all for joining us and I look forward to seeing you next week at our next webinar series. Just look out for, I'm sorry, the next webinar, just look out for the registration link in your email. Good night.
Good night. Thank you.
You're welcome.